Hey everyone, welcome back to the channel. So I want to start with a number that honestly stopped me when I read it. Only 22% of Americans are satisfied with their savings right now. Not thriving, not crushing their financial goals, just satisfied. And only 22% can say even that. Meanwhile, 42% of Americans have zero emergency fund. Nothing. And 31% couldn't cover their basic expenses for even 1 month if they lost their income tomorrow. These aren't numbers from a recession. This is where we are right now in one of the most prosperous economies in modern history. And the reason so many people are struggling isn't because they're lazy or irresponsible. It's because the financial advice most people grew up hearing doesn't account for the actual economic reality people are living in today. So today I'm giving you 28 proven money saving strategies that actually work in 2026. Not generic tips, not skip your morning coffee. Real strategies organized into a real framework that you can start implementing this week regardless of where you're starting from. Let's get into it. Let's start with the foundation. And that means getting honest about your budget. The traditional 50-30-20 rule, 50% to needs, 30 to wants, 20 to savings, is a great framework if it matches your reality. But for a lot of people, it doesn't. If you're spending 70 or 75% of your income just keeping the lights on and food on the table, being told to save 20% isn't advice, it's just stress. So here's a more realistic framework. If you're in survival mode right now, and there's no shame in that, aim for 70% to necessities, 20% to debt obligations, and 10% to micro savings. Just 10%. Build from there. As your situation improves, you move toward the stability budget, then the growth budget, and eventually the full 20% savings target. The other thing most budgets get wrong is that people create them before they actually know where their money is going. Track every dollar for 30 days before you build a budget. Research consistently shows people underestimate their spending by 20 to 30%. You cannot fix a problem you haven't accurately measured. Strategy 2. Set micro-progression savings goals instead of big ones that feel impossible. When 73% of people are saving less because of inflation pressure, telling someone to build a $10,000 emergency fund feels like telling someone who can't walk to run a marathon. It doesn't motivate, it paralyzes. The better approach is micro goals. In your first month, just save loose change and small bills, $20 to $40. That's it. Month 2, add a $5 automatic weekly transfer. Month 3, increase it to $10. By the end of the year, you've built $300 to $600 in savings, and more importantly, you've built the habit and the confidence that comes from actually hitting goals instead of constantly failing at big ones. Small wins compound into big results, and the psychology of success matters as much as the math. Strategy 3, track every single dollar with modern tools. The personal finance app market has exploded because people finally understand that awareness is the first step to control. You need to know exactly where your money is going. Fixed necessities like rent and utilities, variable necessities like groceries and gas, discretionary spending, savings transfers, and unexpected expenses. The unexpected expenses category is especially important. Most people call things unexpected that are actually completely predictable. Car maintenance, medical copays, annual subscriptions, holiday gifts. When you track these patterns over a few months, you start to see they aren't random at all. And once you can predict them, you can plan for them instead of letting them wipe out your savings every time. Now let's talk about debt, because for a lot of people, debt is the single biggest obstacle to saving anything at all. 41% of Americans carry credit card debt with average interest rates above 20%. Here's the brutal math. The average savings account earns around 0.1% in interest. A credit card charges 20%. That means every dollar sitting in a regular savings account while you carry credit card debt is costing you nearly 20 times what it's earning. Paying off high-interest debt is saving money. It's just saving it by eliminating a cost instead of accumulating a balance. Two approaches work here. The avalanche method, pay minimums on everything and throw every extra dollar at your highest interest rate debt first. Mathematically optimal. The snowball method, Pay off your smallest balances first, regardless of interest rate, for the psychological wins. Both work. The best one is the one you'll actually stick to. For student loans, the strategy depends entirely on your interest rate. Loans under 4%, make minimum payments and invest the difference. High-yield savings accounts are currently paying more than that. Loans above 6%, pay those down aggressively. And if you work in public service, government, nonprofits, qualifying education, make absolutely sure you understand public service loan forgiveness before you make any extra payments. Thousands of people who qualify are leaving significant forgiveness on the table. Now let's get into the monthly expense optimization strategies, because this is where most people have more control than they realize. Groceries first. The single most impactful change most people can make is switching to store brands for staple items. We're talking 20 to 40% savings on products that are often manufactured in the same facilities as the name brands. Beyond that, plan your meals before you shop, load digital coupons before you leave the house, compare unit prices, not package prices, and shop the perimeter of the store first, where the whole foods live, before hitting the processed food aisles. For utilities and service bills, cable, internet, insurance, phone, most people just pay whatever they're charged without ever questioning it. That is a mistake. Call your providers annually and ask for a better rate. Research what competitors are charging before you call. Ask specifically for the retention department. A single phone call can save you $20 to $40 a month and takes less than 30 minutes. That's over $400 a year from one conversation. And subscriptions. The average household is now paying for 4.3 streaming services. Do an audit right now. Go through your bank and credit card statements and write down every recurring charge. Cancel anything you haven't actively used in the last 30 days. This exercise almost always surfaces $30 to $60 a month in forgotten charges. For shopping and spending, the strategy is friction. Make it harder to spend money impulsively. The 30-day purchase rule is the most powerful tool here. Anything under $50, wait 24 hours. $50 to $200, wait a week. Anything over $200, wait 30 days. If you still want it after the waiting period, it was probably a genuine need or want and not an impulse. And for lifestyle commitments like gym memberships or new subscription services, wait 90 days before signing up. Most of the time, the impulse passes. Beyond the waiting rules, remove saved payment methods from websites, delete shopping apps from your phone, use cash for discretionary spending categories. These small friction points interrupt the automatic spending behavior that costs most people hundreds of dollars a month without them even realizing it. And secondhand shopping is genuinely underrated. Clothing at thrift stores runs 70 to 90% cheaper than retail. Furniture 50 to 80% cheaper and often higher quality than new budget options. Books, media, home goods, 80 to 95% cheaper. If you're not at least checking secondhand options before buying something new, you are leaving serious money on the table. Let's talk about income optimization, because saving strategies only get you so far. The single most overlooked source of free money is your employer's benefit package. Most people use their health insurance and contribute to their 401k and stop there. But health savings accounts, if you have a high deductible health plan, offer a triple tax advantage that is genuinely one of the best financial tools available. Contributions are tax deductible. Growth is tax-free. Withdrawals for medical expenses are tax-free. And after age 65, you can withdraw for anything penalty-free. On top of that, are you capturing your full 401k employer match? If not, you are leaving part of your compensation on the table every single paycheck. That match is an immediate 50 to 100% return on your contribution. Nothing else in personal finance comes close to that return. For additional income, and I know not everyone has bandwidth for this, but hear me out, even a modest side income changes the math dramatically. Tutoring, freelancing in your skill area, renting out a parking space, delivery driving, selling digital products. The goal isn't to work yourself into the ground. It's to create one additional income stream that makes your savings goals achievable without having to cut everything you enjoy. Now the automation strategies. And this is where most people's savings plans succeed or fail. The hierarchy is simple. It is automate your essential expenses first. Rent, utilities, minimum debt payments. Then automate your savings transfers second. Emergency fund, retirement, specific goals. Whatever is left after automation is your discretionary spending. This is the pay yourself first model, and it works because it removes the daily decision of whether to save. The money moves before you can spend it. And for your savings accounts, if you're keeping your emergency fund in a regular savings account, earning basically nothing, please fix that today. High-yield savings accounts at online banks are currently offering 4 to 5% APY. That's not an investment account with market risk. It's an FDIC-insured savings account that pays you significantly more just for choosing the right institution. Let's talk about the emergency fund because 42% of Americans don't have one, and it's the single biggest source of financial fragility for most households. Think of it in 4 tiers. Tier 1, your immediate goal, is just $1,000. That handles most minor emergencies without credit card debt. Tier 2 is 1 full month of expenses. Tier 3 is 3 months, enough to handle job loss or a major repair. Tier 4 is 6 months, full financial security. Most people try to jump straight to Tier 4 and get overwhelmed. Build Tier 1 first, celebrate it, then build Tier 2. The point is that each tier makes you dramatically more financially stable than you were before it, and the progress is meaningful at every step. And finally, let's talk about the long game, because saving money is only half the picture. The investment hierarchy for anyone building from scratch goes like this. First, capture your full employer 401k match. That's an immediate guaranteed return. Second, eliminate high-interest debt. That's a guaranteed return equal to whatever interest rate you're paying. Third, build your emergency fund so market volatility doesn't force you to sell investments at the wrong time. Fourth, open and contribute to a Roth IRA for tax-free retirement growth. Fifth, increase 401k contributions beyond the match. And sixth, taxable investment accounts for additional long-term wealth building. And invest in yourself. Career certifications, skill development, financial literacy education, even practical skills like cooking and basic home maintenance. These compound just like financial investments. A skill that increases your income by 15% this year pays dividends for the rest of your career. All right, so let's bring all of this home. 28 strategies. And I know that sounds like a lot. But here's the truth. You don't need to implement all 28 at once. You need to implement the right 3 or 4 for where you are right now. If you're in survival mode, build the micro savings habit, cut subscriptions, and start tracking every dollar. If you're in stability mode, tackle high-interest debt aggressively, optimize your grocery and utility bills, and automate your savings. If you're in growth mode, max your employer benefits, open a high-yield savings account if you haven't, and start building additional income. The through line across all of it is this. Build systems, not willpower. Automate good decisions so you don't have to make them every day. Start smaller than you think you should. And be consistent even when the progress feels slow, because small changes compound into life-changing results over time. 73% of Americans are struggling to save right now. You don't have to be one of them. And it starts with one decision. Pick one strategy from today's video and implement it this week. If this was helpful, drop a like and subscribe. I put out videos on personal finance and building wealth every single week. And let me know in the comments, which strategy are you starting with? I read every single comment and I would genuinely love to know. I'll see you in the next one.